Welcome to day one of EUR JPY strategy number 1, a rule-based 10-minute breakout method built around structure, timing, and disciplined trade management. In this lesson, we are not trying to predict every movement in the market. Instead, we define a reference price, place objective orders on both sides of it, and allow price itself to reveal the direction. The chart will demonstrate the complete process, from the first reference point to the final daily result. The active trading window runs from midnight until 7 p.m. London time, using 10-minute intervals. At exactly 12 a.m., the market price becomes our first reference point. Every decision that follows is measured from that level. This removes guesswork. We are not chasing candles or reacting emotionally. We are executing a predetermined framework. From the reference price, place 2 pending orders. The buy order sits 12.5 pips above the reference, while the sell order sits 12.5 pips below it. This creates a balanced breakout structure. We do not decide in advance whether EUR JPY must rise or fall. We prepare for both possibilities and wait for momentum to choose the active side. Each pending order uses a 25 pip stop loss and a 50 pip take profit target. That means the planned reward is twice the initial risk. The numbers are fixed before entry, so risk is defined before market pressure begins. The purpose of this structure is consistency, the same distance to entry, the same protective stop, and the same target on every valid setup. The moment one pending order activates, cancel the order on the opposite side. This is essential. Once the market commits to one direction, the unused order is no longer part of the setup. Leaving it active could create an unwanted second position during a reversal. Think of the 2 orders as one decision. Price may select the buy side or the sell side, but never both. Here, we can see the reference line and the 2 entry levels being positioned around it. The upper area represents the buy breakout plan, and the lower area represents the sell breakout plan. Notice how the chart is transformed into a clear decision map. Before price moves, we already know where entry occurs, where the trade becomes invalid, and where profit will be taken. The colored zones make the trade geometry easy to understand. The entry sits between the protective stop and the profit target. This visual preparation is more than chart decoration. It is a discipline tool. A trader who defines the complete trade before entry is less likely to move the target impulsively, widen the stop, or invent a new rule after the position is live. Now the important work is patience. Price is moving inside and around the reference structure, but no action should be taken until a pending level is actually reached. A systematic strategy does not reward anticipation. It rewards correct execution. We wait for a confirmed activation, cancel the unused order, and then manage only the position the market has selected. Once the active trade reaches 20 pips of open profit, move the stop loss to the entry price. The trade is now protected at break-even, subject to normal spread and execution. This adjustment changes the character of the position. The original downside is removed, while the full 50 pip target remains available. The key is not to move the stop too early. The break-even rule is applied only after the complete 20 pip threshold has been achieved. The chart now demonstrates why patience matters after entry. Price does not always travel to the target in a straight line. There can be pauses, pullbacks, and periods of consolidation. The strategy does not require constant intervention. After the break-even condition is satisfied, the trader allows the original plan to work. We manage by rule, not by the fear generated by every individual 10-minute candle. The directional move extends, and the trade reaches the planned 50 pip take profit level. This is the reward for following the complete sequence. Define the reference. Bracket the market. Allow one side to activate. Cancel the opposite order. Protect the position at plus 20 pips. Then hold for the target. The result is not based on hindsight. Every important level was established before the move unfolded. Because the completed deal ended in profit, the strategy does not wait for the next full hour. Instead, the next 10-minute candle provides the new reference point. This is an important distinction. After a profitable trade, reset at the next 10-minute interval. After a losing trade, wait until the next full hour before establishing a new reference. The outcome of the previous trade determines the timing of the next setup, not the direction of the next order. The same structure is now prepared again around the new reference. There is no change in the entry distance, stop loss, profit target, or break-even rule. A robust process should be repeatable. The trader does not become more aggressive after a win or attempt to recover emotionally after a loss. Every valid setup is treated as a new event, using the same measurements and the same discipline until the 7 p.m. London cutoff. As the example approaches the end of the demonstration, remember that the strategy operates only inside its defined London time window. A setup should not be forced simply because the session is nearly over. The cutoff exists to maintain consistent testing conditions and prevent discretionary trading outside the plan. The worksheet shown at the end records the day one example: a starting balance of €1,000, a result of plus 50 pips, a displayed daily profit of €248, and an ending balance of 1,248. This single result is an illustration, not a guarantee of future performance. The real lesson is the process: precise reference points, symmetrical pending orders, predefined risk, immediate cancellation of the unused side, break-even protection at plus 20 pips, and outcome-based timing for the next reference. In strategy number 1, discipline is the edge, and consistency is the objective. Study the rules, test them across a meaningful sample, record every result, and judge the strategy by its complete data, not by one trade or one day.